What's up, guys? Your boy Quick Stocks is back. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis. Today, I'm going to get into what I wish I would have known before I started investing. Hopefully some of you guys can learn from my mistakes, and I can save you some of your hard-earned green. Let's start off with the obvious. I wish I would have had more cash so I could have maxed out on AMD or Tesla, am I right?
Boo, you stink!
But for real, this is your quick stock analysis. I'm going to start with a big one. It's not sexy, but I seriously can't overemphasize the importance of this. I'm telling you guys, you gotta know the difference between short-term and long-term capital gains. If you hold shares in a company for less than 1 year before selling, you'll have to pay short-term capital gains, which usually equates to the same tax bracket as your regular income, generally 20 to 30%. Bloop the chart. In other words, if we had a participant that we will call Billionaire Bobby, if Billionaire Bobby made $20,000 annually from his day job, and on top of that, Billionaire Bobby made $20,000 trading Tesla, which he held for less than 1 year. His total taxable income is now $40,000, and he will have to pay around 22% of that money back to Uncle Sam, meaning Billionaire Bobby would lose over $4,000 on his 20 grand Tesla profit, making his net profit closer to $15,500. However, if Billionaire Bobby would have held his position for over 1 year and made less than $40,000 in that fiscal year, it would be completely tax-free, baby, and that $20,000 would be all his. So, just to really drive this in and then we can move on, if you held stock in whatever company for less than 365 days, excluding leap years, you're going to have to pay your regular tax rate on those gains. And if you would have held it for simply 1 day more, it would potentially be completely tax-free. And if not tax-free, substantially less. Which leads me to my next point. Tax-free vehicles such as 401ks and Roth IRAs. I'm not going to go into great detail because I've already made videos regarding the subject, which you can check out, links in the description. But guys, I can't emphasize this enough. The government doesn't give out many free golden tickets, and when they do, you need to take them.
You found Wonka's last golden ticket in my shop too.
Listen, I'll buy it from you.
Just to put this into perspective, not to count my chickens before they hatch, by the time I retire, my Roth IRA will literally save me millions of dollars just in taxes alone. Next, I can't tell you how many beginners I've seen making this mistake. Share prices do not equal market cap. As an example, just because Microsoft is trading for $183 a share certainly does not mean that Microsoft is worth less than Tesla, whose price per share is $800. In other words, you should look at a company's market cap or capitalization when judging a company's valuation. A company's market cap equals the number of shares outstanding times current share price. A lot of people aren't going to like this one, but it's the truth. There's a decent potential if you have high interest loans, you would be better off paying those off rather than investing. Just to put this into perspective, if you have to pay interests higher than you reasonably think you can make back in your investments, wouldn't it make more sense just to pay off the loans without taking the unnecessary risk? If you're young, consider taking some risk. Put some of your money into good quality spec plays. It'll keep you interested and willing to learn more. However, in my opinion, if you haven't made a contribution to your 401k or Roth IRA, you really should lay a strong foundation before jumping into YOLO territory. Which leads me to my next point. Paper trade. If you want to trade penny stocks or options, please try with imaginary money first. You'll save yourself a lot of dopamine. I promise. Buy what you know. It's as simple as it sounds. If you don't know anything about semiconductors, should you really be investing into a single semiconductor company? Obviously, there are exceptions. I'm not as opposed to ETFs. I can't fault someone for wanting to get into on the booming AI or cloud industry, just to give an example, in which case I would much prefer a beginner to open a position into an ETF, where an expert is investing your money for you into a specific market. Don't rule out the idea of trusting someone who has made a career out of studying these markets. I can assure you they know more than the average investor. However, this leads me to my next point. If you're letting someone else invest your money for you, for the love of God, check the commission fees. Don't leave your green somewhere that someone else is getting rich off your hard-earned money. I've seen accounts with management fees of 8%, which is financial insanity. As always, here at QuickStocks, we recommend the ETF QQQ. Seriously, if I could offer you one tip for the future, invest in QQQ. It mimics the Nasdaq 100, and a majority of active funds and even more active traders don't end up beating the market. The Nasdaq 100 is a top-tier benchmark, guys. Consider taking advantage of it. Shameless plug, check out my video about the Nasdaq 100. Link in the description. Start now. The best time to plant the seed was yesterday. The second best time is right now. I seriously can't overstate the power of compound interest. If you are in your 20s and take advantage of that compound interest, you will become a multi-millionaire if you're lucky enough to live that long. Don't lose your mind over day-to-day fluctuations. This is the long game, boys. We're all about endurance. Don't burn yourself out on the first lap. Sometimes the best investment is the one you already own. Tesla. However, there's a reason the stock is cheap. ACB. Don't listen to people promising you 40% compound annual returns by following this one simple trading strategy. Seriously, if you can consistently make 20% compound annual interest every year on your investment, you are absolutely crushing it and will become unbelievably wealthy if you don't lose focus. Dollar cost averaging is the way to go. Don't worry so much about trying to buy the dip. The average investor is far better picking a company or index he or she believes in and setting aside a set amount of money to put into that company every month, regardless of share price. I could go on all day. However, this video is getting long, and I'm sure this has given more than enough information for new investors to chew over. This was your reporter, QuickStocks. As always, the best investment you can make is to go long on QuickStocks. Hit that subscribe button now at 190 subscribers and plan an early retirement. I'll catch you guys in the next one.